We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is David Haggith, author of the Daily Doom Substack. Thanks for joining me today, David. How are you?
Good. Thanks for having me on.
Great to have you back. You know, David, we're speaking here towards the end of August, and we've seen inflation come down a bit. And of course, the Jackson Hole Fed meeting is this week. So let's start by getting your sense of what the economic situation is in the US at this point. And has it created a position that the Fed can kind of maneuver from now?
Yeah, I think inflation is a really good point to start out with. That was my big prediction for this year. Last summer, I started saying that inflation, there were things rising in the background on inflation that were going to cause inflation to go up in the months ahead, particularly in 2024. And at the time, nobody was saying that I was reading. I was kind of, the Lone Ranger out there, and everybody's like, oh, inflation's going down. The Fed's doing a good job of beating it. We're going to have this thing done. The Fed will be cutting rates by 2024. And then as we got closer to 2024, they got more specific and said the Fed will be cutting rates in March. And of course, all along the way, they've been talking about the Fed pivot. And I kept saying there will be no Fed pivot. Absolutely not. And then as we got closer, towards when they're saying we're going to cut rates in March, I said there's not going to be any rate cuts in March, if anything. By March, the Fed's going to be in a position where it's going to have to look at a rate hike. It won't do that because it won't have the courage to do that. But that'll be the position it'll be in where it's starting to see that, inflation's going the wrong direction. And of course, that's what happened, right? The first 3 months of the year, we saw inflation ticking back upward again. And the Fed started, saying, started to seem a little more questionable about inflation. And so that's what I was saying last summer, that we would see that coming along, and we did see it coming along. And this year, I've been saying we probably see a second wave of that coming along towards the end of summer, and have a number of reasons why I think we would see that. And one of those reasons is the lag time on housing inflation. A lot of people would say, housing has come down in price, and it's that's starting to factor into the readings, and we should get a break from housing inflation. I'm like, no, housing came down for a while, but that was a year ago. It's been going up ever since then for an entire year, and housing has a 1-year lag time of when it goes into the CPI report, at least a year, maybe a little longer. So I said, we've been climbing for an entire year, and housing has been soft in inflation compared to what it would be based on what today's prices have been, which are much higher than they were a year or so ago. So we're going to now start where that uphill climb starts pricing into CPI. Housing should start putting more pressure if it does what normally happens with CPI. The lag is just about to where we hit the bottom of when housing was coming down. Now we're at the bottom. So I've said probably late August, September, we're going to see it start to rise. And we did kind of see some indication in the last inflation reports that housing wasn't as helpful as it had been in coming down. I think we're going to get less help from housing coming down. I said oil prices are probably going to go up in the summer because that's what they do, and that's going to start having some inflationary effects. And then if with these wars and everything, it could be oil goes quite a bit higher. And if that happens, that'll have significant inflation effects. So it's not just the price of gasoline that we're going to be paying for, but it's the fact that oil gets priced into everything. And so, of course, the cost of other things will start going up over time if oil takes a turn, above $80 a barrel and holds up there for a while. And it's going to affect the transport of everything. But, oil is an ingredient that goes into a whole lot of things. So that's going to push things up. And then I've been noting that producer prices have been going up. That's the price that producers charge to the people who are going to warehouse and then who are going to retail the products. Those have been going up, and that's going to create pressure to go through. But there's a lag time with that too. Even though those have been going up now, the lag time is most of what's being bought now is being bought for holiday sales. So, and you don't see whatever price increase retailers get, you don't see it until that product goes on the shelves. It doesn't affect the products they already have. It prices through when the product gets shelved, right? And so when the holiday season comes along, we could see upward pressure on inflation from that potentially too. So there are a number of factors that could, push inflation back up. And what happens if the Fed decides in September, well, hey, we're in a real cherry spot to start cutting rates, and right as they do, inflation starts rising again. So, and I think that should that happen, we could see like we did in the 70s, where we had this kind of, double spike of inflation, where they thought, okay, we've got this pretty well battled, and they started backing away from the battle, and then boom, it shot up even higher than it was before. I wouldn't go as far as to say it will go higher than it did before, but if the Fed starts cutting interest rates and inflation starts creeping back up, that could certainly accelerate it. And, then we're back to fighting this battle all over again. How exasperating will that be?
Mm-hmm. Yeah, I mean, trying to wrap our heads around the lags that all of this happens with, I think is a real challenge. But yeah. David, when you're telling us that the Fed, really hadn't seen any or did not foresee any cuts whatsoever coming, why do you think that is such a change? Like, what happened to the Fed's vision or how they were seeing this stuff to make it so resolute to keep rates high and or hike them further?
Well, I think really what happened was not so much anything with the Fed as with markets. Markets were almost intentionally misreading the Fed. I would, constantly see people saying, oh, Powell said this, that means there's going to be a Fed pivot. And I'd look at what Powell said and I'd say, no, he didn't say that. Mm-hmm. And I would parse it down and say, look, here's what he really said. He said, that there would be some hope in the future of rate cuts. I said, that's so vague. It doesn't mean it's happening tomorrow or next month or even this year. So I think the market was constantly leaning towards wanting that pivot. And I just never saw it in the Fed's language. So even as we, came up to 2024 and people were talking about a pivot in March, I pointed out he didn't say that actually. And I don't think that's going to happen because inflation isn't going to let it happen. He keeps saying, well, if inflation continues, it was kind of like this thing, as we were in the fall last year, it was if inflation continues to moderate, then, and the market continues to do as it does and do its tightening for us, then we will be able to cut rates. And the market pegged that as, okay, by March, this will happen. Mm-hmm. But as soon as he said that in October, the market immediately cut slack in everything. All of a sudden, the market was like, whoa, the Fed's almost done. And the market ran wild and conditions got much looser. And all of the tightening that Powell had put into place suddenly just dissolved away as, bonds flipped, stocks flipped, everything started getting looser and juiced up again because they thought Powell was coming to an end. And what he had really said is if the markets continue to do this tightening for us, then we might be able to back down. And just by saying that, he triggered an avalanche where he undid all the tightening that the Fed had put into markets. So that's kind of what we saw last year that then put him in a place where he's like, well, we can't do this yet. Now we got to tighten back up. And now he's come to a place where he does sound like he's flipping and where he does sound like they, will want to do a rate cut in September. And that's because he sees, not only that inflation has started to go back down again after its rise earlier this year, just a little bit, nothing really much, and sees that the labor market is starting to show some signs of, rising unemployment. So those are his two big things he's got to weigh all the time. Is he's got two mandates. One is to keep a strong employment market, and the other one is to keep inflation down. He's kind of won on the inflation side, it looks like, but he didn't have any slack from the labor side to say, yeah, let's go ahead and start cutting rates because labor, he kept saying, was really, really tight. So why would you then cut interest if you're saying the economy is strong and resilient and labor is tight? You wouldn't do that. So he needed permission from his other mandate, basically, to say we can start cutting. Mm-hmm. And it's now given him the appearance of that condition that he needs, where labor unemployment is starting to rise. So I think he's at a point where he's feeling, we're going to come in for a soft landing here, and it's time to ease up a little bit.
So that was actually exactly where I wanted to go. Like,
Okay.
when we think about all of these lags and the data that they are so dependent on, what do you think the likelihood or the percentage is that we get an actual soft landing this time?
I don't think it's very good, because one of the things I've been saying is I think we're already in recession. And for a while, I wasn't really hearing anybody saying that. I call it a stealth recession because it certainly doesn't show up in GDP. If you look at GDP, we're far from a recession. It's actually been improving. At the start of the year, it kind of looked like GDP was, in a significant decline, and then it's bounced back up again. And I didn't hear too many people saying that, but recently I heard Daniel DiMartino Booth making a big case that we are already in a recession.
Mhm.
And so if we're still tightening and we're in a recession, then I think we're going to go deep into a recession. And the other thing that's come along that strongly confirmed what I've said about already being in a stealth recession is there's this thing called the Sahm rule, which says that when unemployment rises 0.5% above its low, I'll put it in simple terms, not get into the nitty gritty detail. When it rises 0.5%, it hits a Maginot line where all of a sudden it goes parabolic straight up, and immediately we're in recession. And in fact, I heard an interview with Claudia Sahm, who was a Fed economist who came up with this rule. And she said that it not only means when you pass that point that you're going into a recession, she said it always means you've been in recession for 3 months. And it never fails at that. She said you can go back to 1950 and test this rule against every recession we've had, and it's 100% reliable back to about 19, maybe a little bit after 1950. Before that, they had a couple problematic things where it missed by a few months was all, but just by a few months. So it's basically always worked since the Great Depression, plus or minus a few months in its timing. So we passed that point just as we went into August. We tripped past that barrier. Now, according to her, that means we've been in a recession for 3 months already prior to August, when, or it was actually July's readings. So prior to July's readings that were reported in August. So you've got that, Daniel DiMartino Booth, she comes at it from looking at unofficial employment reports, not the government, by which I mean not the government reports, but by her interactions with industry and what's really happening with unemployment and hiring. And she says, based on those metrics, we're solidly in a recession. So if we're solidly in a recession and the Fed has still been tightening all along, then I think for the reason of those lag effects you talk about, it takes another lag effect, as it can take a year for Fed policy to really change the economy much. So the Fed, if it does start, changing its policy in September, it's already behind the curve on this. So I don't think we're going to get that soft of a landing. I would be surprised if we did. If we did, hats off to Powell. He's one skillful pilot, but I think we're going to land inverted on the top of the plane.
So why is the Sahm rule really necessary, and why can GDP be so misleading?
Yeah, good questions. The reason Claudia Sahm invented the rule is she said we need something other than GDP to gauge a recession by, because we don't gauge a recession in order to set policy, fiscal and financial. And she said, especially financial, because she was working for the Fed at the time. She said, we need something that is more, much more timely than GDP, because we don't set a recession officially by GDP until it's been negative for 2 full quarters. And then we declare the recession retroactively. So we'll say, okay, well, 6 months ago, we entered a recession. Well, fat lot of good that does for, changing policy. You're already deep in it by that time. So she said, we need something better. So that's where she started studying, looking to see what kind of indicators she could find that were more reliable. And she found that if you measure unemployment in a certain way, it was spot on reliable to say the recession has begun just 3 months ago, which is a whole lot better, 3 months ago, a whole lot better than 6 months ago, right?
Mm-hmm.
So it was to try to shorten up that time frame so that we could get policy changes before we're too deep into the recession. Of course, she probably hoped to hit something that would predict the moment it starts, but 3 months is as close as this rule came, and it makes it the closest rule we've got. There's nothing else that predicts it that reliably. And she said the other thing we wanted was something that was free of the politics that kind of get worked into GDP. GDP is a government reported number. It's got a government report, it's real GDP we go by, which means it's adjusted by inflation, which is a government reported number. And so she said we wanted something that was politically free. And so this is why she came up with that number based on labor. GDP, if you don't subtract out the right inflation, then real GDP isn't real. And, I've argued for years the government isn't anywhere close to, subtracting out the right inflation, as John Williams says, in shadow stats, which you're probably familiar with, that, the government underreports inflation substantially, which it does because that helps save it money on Social Security.
Right.
Doesn't have to boost those payments up as much for COLA. And it's got really stupid metrics in it, like how do you figure out the price of housing inflation? Well, you ask homeowners to guess what they think they could rent their house for, and that's what you report as the cost increase for homeownership. What does a homeowner know about what his house would rent for? If there's anybody that knows less about the rental market than anybody, it's a homeowner. He hasn't been in the rental market probably for years, and you're asking this person to say what his house would rent for. Well, he doesn't know what his house would rent for. So it's kind of a ridiculous metric from that standpoint. Mm-hmm. So we got a problem with we don't take out the right amount of inflation, and that can make GDP unreliable. And this may stay a stealth recession. GDP may never come along to confirm it, but labor's confirming it. The rise in unemployment is. And so, yeah, I don't think we're going to have a soft landing.
So then, David, how do we also take into account what the COVID era, let's say, did to the economy and how that ended up affecting the comparisons for the Sahm rule as well?
Oh, yeah. And there's where the Sahm rule could be off, but it will be off for the very reasons I've said the Fed will be off, which is that I've been saying ever since the year COVID hit, like that summer, that the labor metrics are going to be really messed up here because we damaged labor so badly with those lockdowns, that we didn't really need to do for COVID.
Yeah.
We damaged it so badly that the metrics are all screwed up. And so ever since then, I've been saying, if the Fed is going to gauge, one of its main ways of gauging when it's going to change its policy on tightening is by when unemployment changes, that metric is going to be slow to change. And I said the fact that, we had a recession there, but it wasn't declared because of the fact that labor didn't cooperate. The NBER that declares these things didn't see the kind of change in labor that it needed to. Labor looked tight as we came out of those lockdowns. And my claim all along was labor was not tight in the traditional way that labor is tight. We usually think of that as labor tightens up because there's a high demand for labor. And labor is not able to keep up with that. So all of a sudden, there's just not enough workers to fill the demand we need because people really want products and you can't get there. But what really happened was labor got tight was because there was a fall off in laborers. And so retired due to COVID, whatever, we had this huge drop in laborers in the labor pool that never came back. And so labor was not tight because demand for labor was so high. It was tight because available workers were so low, totally different than something we've ever seen before. We've not had a situation where, labor was tight because there just weren't enough people needed or wanted a job. And so I said, that's not indicative of a strong economy. It's actually indicative of a severely broken economy, because if you can't get workers, you can't produce. So production would, presumably come down due to a lack of people able to do it. And you could see that in everyday life, particularly in services. You go to a restaurant, and I don't know where I live, you'd see signs on half the restaurants out there, help needed, right? And you'd see they were cutting back on their menus, they were cutting back on their hours. That reduces production and services. And so that's not a problem we would readily and easily recover from. I said these people weren't coming back to work. They had retired but the labor pool was short by about 4 million people from what it had been. And it's finally recovered back up to the number of laborers in the labor pool that we had before COVID. However, it has not recovered back to trend. Here's the trend line going up for labor, and it's very consistent over the years, basically matching with population. And then it cut off in COVID like this, and we've recovered back to where we're here. But if we were back to trend, we'd have to be all the way up to here. Mm-hmm. And we never recovered back to that. And that means population has grown, but we don't have enough growing workers to match up to that growing population.
David, what other data is telling us that we're, already in a recession?
Well, I think those are the main metrics that I've got to go by is producer prices that are going up on inflation. That's more inflation data for recession. You kind of caught me on that one a little bit off the top of my head. But
I know I saw a chart. I think it was yesterday on credit card defaults and also just the outright number of or dollar amount of credit cards outstanding right now. And they're both at like incredible all-time highs that dwarf anything else from the previous years of that chart.
Yeah, and if you mean things like that, then okay. There are certainly indicators that we would be in a recession. I mean, you look at commercial real estate defaults, credit card defaults. Clearly, there's some major trouble in the economy that would match up with the idea of we're being in a recession, or we're certainly going to go into a recession. Credit card defaults, like you say, are on the rise. Commercial real estate defaults are through the roof. And of course, we've had this ongoing retail apocalypse for some time that's just getting worse in spades all the time. You got Macy's closing another 150 stores this year. All of those things are certainly recessionary in their impact, whether they indicate we're in a recession or going into one. There's some very negative news there for sure.
Mm-hmm. So then on the other side of that, David, what effect is this really kind of having on the markets? And should market participants really be expecting more volatility into, basically into the election?
Yeah. One of the things that you've heard a lot with the market is we had this huge surge, right? It's, kind of the irrational euphoria thing where we had this big price up led by basically artificial intelligence. And people believing artificial intelligence is the wave of the future. It's going to change the world. It's the new paradigm. And maybe it is all of that. And saying, therefore, it can't come down because these companies are driving the future. They've got tremendous future potential. So there's reason for their stocks to price up to 40 times earnings, which I think is a little ludicrous in itself. But that's the belief that was out there that was driving all this momentum. And then we saw, and I said, that's not true. I said, it might be true that this is the wave of the future. But the common market idea that was being broadcast all over the place at the time, that we couldn't see these stocks crash because they're the wave of the future. I said, this is the same nonsense that we saw back in the dot-com bust in 2000, where everybody was saying the same thing. And, and it was funny because I'd read people saying this is nothing like the dot-com bust because these stocks are the wave of the future, blah, blah, blah. And I'd argue back, that's exactly like the dot-com bust. Why can you ninnies not see that you're doing exactly the same thing? That's exactly what everybody said back then, is the internet was the wave of the future. And the companies like Microsoft and Google and others that were, going to be leading in the internet, they couldn't possibly go down and crash because they're the wave of the future. Well, guess what? They crashed so hard. It took 10 years before they finally recovered back to where they were. Are they the wave of the future? Yeah, they were. I mean, the internet changed the way we do business. There's no doubt about it. But they crashed for a 10-year slump before they ever recovered back to where they were. And the same thing can happen today. And then we saw it start to happen as these stocks started peeling away and started going back down. in the last couple of months. And so it's just like the dot-com bust. And the other thing about the dot-com bust is it didn't fall off a cliff. It went down for like 3 years, one waterfall after another, series of steep downhill rapids, and finally got down there. And that's what I think we would see at this time. What happened in the dot-com bust is there were companies that had done very good and they evaporated. They're not around anymore. So some blew out and some survived. The survivors came back to be stronger, bigger, and better than ever, but not without going through the bust along with the rest of them. And that's what I think we'll see happen with AI. It's leading the bust down, just like those companies did back then. They led the way down and pulled other stocks down with them. And I think that's what we've seen. And I think we've got more of it to see because they're still priced ridiculously high. So how the election will affect it, I think the market generally discounts elections. Maybe the election outcome might affect it, but the market likes to look at things that are predictable, and an election's not that predictable, especially when it's as tight as this one. So I don't know how the election will affect it. It's hard to say. But I do think that it's very easy for those stocks to crash. It's also very easy for something like the types of problems we're seeing in commercial real estate, et cetera, to sneak up on you in the way that we saw a stock crash sneak up in 1987, where we fell off an absolute cliff. Mm-hmm. That would be a lot different than the dot-com bust because that was a sharp fall with a sharp recovery. And I don't see a sharp fall with a sharp recovery, but it does show you how quick things can turn when you think everything's invulnerable. The dot-com bust does a better job of showing you how things can just go down, 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 and they went down relentlessly for almost 3 years and then took another 10 years to crawl back out of that. And I think that's more likely what we're going to see.
So can we kind of combine, it would be good to get a sense of where you think we are really kind of as a combination of the markets and the economy. Are we in a place where we're basically getting to levels like the 1987 crash combined with the inflation cycles and tops from the 70s?
Yeah, the 1987 crash certainly played in with the inflation cycles. I'm not exactly sure what the connection was with there, but certainly in the 80s, when Paul Volcker was tightening, we saw this sort of double effect with inflation, where they thought they had it beat, kind of like where the Fed is right now. And then they discovered, after they started loosening rates, that inflation went right back up. And then it was an even harder battle to fight. And I think that that's what we're probably going to see here, where the pressures that are pushing on inflation probably will drive it up. And if the Fed loosens, that adds to that and increases the likelihood that we see inflation go back up. Mm-hmm. So we could see that. And that would mean we got the whole fight to do all over again, which would just be exasperating to people. So I think that's the kind of time we're in, where the inflation battle isn't over yet. And if the Fed moves too much, it's going to make it worse for all of us.
As we think about the volatility that we're seeing right now, or that we have seen over the last 2 weeks here, David, how do you see, the wars all around the world affecting the stability of the markets and basically investor confidence as well? Does that play into this volatility to you?
Yeah, I think, in terms of the market somewhat discounts war until it triggers something economic that happens. Mm-hmm. Because of the fact that, again, it's unpredictable. So how do you price that in? So the markets have tended to somewhat discount, not discounted in price, but ignore the war picture until something serious happens. But that's the situation we're in right now, where something serious could happen very quickly, right? So one of the things that I've been writing about is what's the situation with Israel and Iran. Now, I can't predict what's going to happen there. Nobody can, not even the people who are negotiating. But what I look at is I say, okay, Iran has the potential to totally change the price of oil. If we get, involved in a major conflict with Iran and they decide, you know what, we're just going to start sending missiles at every ship that tries to go through the Strait of Hormuz, and we're going to, just create disaster for you. They obviously have the ability to do that and drive oil prices right through the roof. So they could do that if we get involved in a full-on war with Iran. Now, what's the likelihood of that? Well, the thing that I've been looking at is, okay, just in the past week, we've had a couple of people in Israel and a person running a think tank here in Georgia all saying that Iran is about 2 weeks away from having a nuclear bomb. 2 weeks. Okay. But I put a big caveat on here. I've heard for 20 years from, ever since Netanyahu got out his picture of a big round cherry bomb and showed we were right up almost to the very top of where Iran needs to be to have enough nuclear material to build a bomb, that they were only a year away. Mm-hmm. I mean, that was what Netanyahu said almost 20 years ago. And it's what we've heard ever since. Iran's a year away. And obviously, a year just turned into 20 years. So how much does 2 weeks turn into? I don't know. So in one sense, take that with a grain of salt, because they've been over predicting this in order to heighten the risk factor, and particularly the warmongers like John Bolthead, who wanted to, always get in a war with Iran to end the problems, want to heighten it. That said, one has to think that after 20 years and with the removal of, the sanctions and things that were restraining Iran, and not that we've removed all sanctions, but, the whole treaty thing that we developed, with that gone, with the inspections gone, you'd have to think they've made some considerable progress, because they clearly want to get a nuclear warhead. I mean, there's no way you do the types of refining of uranium to the levels that we know they've already reached at this point for medicinal reasons. There's no medicine that needs 60% pure uranium. Mm-hmm. So there's no question they're pushing to get a nuclear warhead, because it changes the equation for them, and they've always said we're going to annihilate Israel, and so they're probably getting very close. So where that comes to is whether the 2 to 3 weeks is right or not. We're probably pretty close to them having what they need. The latest news is they have all that they need, and what all they're waiting on now is the perfection of a detonator to make it work. And who knows where they are in that process. So with that, then I think that if Iran launches the retaliation it's talked about in response to Israel assassinating someone on Iranian soil, then that could very well be a situation where the U.S. and and Israel finally say, you know what, we promised you that we will stop you from getting these no matter what it takes. And where they would use that war as their opportunity to say, okay, we're going in, we're taking out your nuclear facilities, we're taking out all whatever you've stored up in the way of nuclear weapons material, and we're getting that cleared out of there. And that, would be very difficult, because you can't just go blow up a nuclear reactor without creating a nuclear disaster yourself in doing it. You can't just go, if they do have weapons grade material stored or even warheads waiting for detonators, you can't just go blowing those things up without creating, huge problems. So that probably means something more like regime change, where you've got to get control of the country to a level where you can go into those facilities and shut them down properly, right? You don't blow up a nuclear reactor unless you're dumb. You go in and you go through the whole cycle process, which maybe takes, I don't know what it takes, a month, 2 months, whatever, to decommission the thing and bring it down. And then you can blow it up and put it out of business once you do all that, once you've got stuff, safely moved out of there and stored away. So would we start that process now? Well, I think we're probably close to doing that. And if Iran were to make a major retaliation, that might be all we need to say, okay, we're done with this, and we're going to go in there and just do what we've said for a long time we're going to do. And that would have a huge impact on the price of oil. But how predictable is that? Well, not at all. We don't know what Iran's going to do. Right now, Iran seems to have kind of backed off a bit from that retaliation. It says it hasn't, but it's definitely appears to be delaying, at least for the sake of negotiations on hostages, so it doesn't upset that. So what's going to happen there, I don't know. But I think, we're getting closer and closer to that point. and very close, where the US and Israel and maybe other Western allies will go in after Iran and say, look, we're just ending this nuclear problem.
Mhm. Yeah, I mean, war and I mean, there's just so many unknowns right now in the
Right.
world. And I think that is something that is such a difficult thing for the market to price in, kind of as you're saying. And when we combine that with this recency bias where we think everything's just going to keep going as it has been, I think these are quite difficult pieces to kind of account for. Another thing that we've been seeing a lot of talk about is this de-dollarization threat, let's say, by the BRICS. Do you see that as another piece of this puzzle that is going to have major effects on the dollar?
Last year there was a lot of talk about how the BRICS were meeting. They were going to form a new currency, and they were going to, that was going to de-dollarize things. There's been a lot of talk about how, we're losing ground to the yuan and, we're de-dollarizing in that sense. I said last year the BRICS weren't going to do that, and they probably weren't even going to talk about it, and they didn't. They specifically made sure that was not on the agenda. There were some nations in their BRICS that did not want to even talk about it. One of those nations is India, because de-dollarization via the BRICS typically means some sort of reliance on the yuan, and India and China are like borderline enemies. Their relationship is not tight enough to where India would ever want to see China start to dominate with the yuan. So you've got a major conflict there, and there's no way that the Indian rupee is going to be a part of a significant currency that's going to de-dollarize. So would they, create a new currency? Well, they might, but let's get some perspective on this de-dollarization. If you look back 20 years and you look at the amount of, the percentage to which the dollar is used in financial transactions, it's gained ground. That might be shocking to some. It's gained about 1.5% over the course of 20 years in its use of financial transactions. And people say, well, it's lost to the yuan because the yuan's risen to now covering about 7%. However, the yuan took all of its market share away from the euro and the yen and other currencies in that same basket of currencies that are not performing as well. So it hasn't stripped any market share away from the dollar. Dollar took some away from the euro and the yen as well. So the dollar has improved a little bit. The yuan has improved quite a bit, but it's still only up to 7%, and the dollar is running like 80-some% of those transactions. So the dollar is still firmly planted and growing. It just that it didn't get as much market share off of the deterioration of those other currencies as the yuan did. So you got to keep that in perspective. Yeah.
Sorry, David, to your point, just to interrupt you for a second.
Yeah.
The last time I actually did speak with Danielle DiMartino Booth, she brought up the stat that in, I think it was 2019, the dollar accounted for something like 18% of global trade. And now it's up to 30, right? So, to your point, this is a growing trend.
Yeah. So I don't think the dollar has weakened in the sense that people think. I think we will come to some form of a currency replacement for the dollar, but I don't think it's going to be because the dollar collapses. I think it's going to be because the global economy collapses. And when that happens, we're going to look for a global answer, unfortunately. And I think a part of that global answer at that point will be there's a lot of pressure towards going into central bank digital currencies. The world's like just hungry for a digital currency. There are plenty of us that aren't, but let's be honest, there's a lot of people that don't care about, what some of us worry about. And they want it for its convenience, and they don't see its risks. And, central bankers want it and governments want it because they can control it. So I think if we go into a global economic collapse, then we're going to look for an answer coming out of that. And I think a part of that answer will be some form of global currency, global digital currency, whether it's just a platform on which many digital currencies can function well together, or it's a single currency. I think eventually it'll be a single currency. It may start out as a platform that they all work well together on, but that's what we're going to see. And so we'll see a move to a digital dollar. or a digital replacement of the dollar that, many nations, and not to be the whole world, but say the West agrees upon. We're going to find a global answer. And in that process, the dollar evolves into something else. It doesn't collapse, but it gets replaced with something else, or it evolves to a digital form and then takes dominance.
So as we're thinking about currencies, David, another part of, I guess, the volatility that we've seen was pointed towards the yen carry trade unwinding. Do you have any idea, how much weight that explanation holds, and or how close we are to the end of that carry trade coming unwound?
Well, only in terms of what I've read. What I've read says the carry trade still has more than 50% of its distance to go if it were to, unwind all the way. So there's plenty of room for that to continue to be a problem. Um, to the extent it will, I don't know, because how do you know how much Japan will capitulate to the pressures it's feeling, right? I mean, it's feeling a lot of pressure
Mhm.
right now, and it's trying to get to a point of running tighter policy after decades of running loose policy. And will it hold to that, or will it cave? Good question. And that will determine, I think, what happens with the carry trade, is how strong they hold to their tightening measures.
Mhm. So, David, as we take all of this into consideration, where do you think the places are and or steps that people need to take to really to be able to protect the value or the assets that they've gained? And how do you think we get through this time?
Yeah, I mean, I wouldn't worry that if your money's in dollars that you're just going to lose it because the dollar is going to bust. But if your money's in banks, there's of course some risk. I don't think it's a lot, because the country will obviously do as it's done in the past, will do anything it can to bail out banks. Whether that's a good solution or a bad solution, that's clearly what it will do. It's clearly what the Fed will do. So they will support the money in that sense. So I don't, at this point, see that you're going to lose a lot of your money in a bank run, because I think the government would come in with the FDIC or whatever and protect that. But I do think there will be more bank troubles like we saw, and of course those can cut you off from your funds for a while until the problem gets sorted out. What you could see is another rise in inflation, and of course that devalues your money. And gold has done very well during this time. If you're looking at gold as something I'm going to transact with in the future when the dollar collapses, are you being realistic about how difficult that in itself is to do? If you're looking at it as a store of wealth, so that as the dollar deteriorates, I've got something that actually goes up in value, yeah, gold is I think, going to continue to perform very well against the dollar. And so it's a good store of wealth. But to transact in it, you're not going to find very many people who are willing to sell you groceries for gold.
Mhm.
And if, in fact, your view is, well, the dollar is going to collapse and be a problem, well, then what are you going to do with, let's say you go to a central bank digital currency and you think, well, I'm going to have gold so I don't get locked out because I don't want that. How are you going to transact your gold when you can't turn it into dollars because you're not part of the central bank digital currency? So what are you going to sell your gold for? Goats? You're not going to you can't sell it for money. To some extent, you could, trade it to Bitcoin and transact in that, but that's very limited right now in terms of what you can really transact and do. You can't go to the grocery store and buy your groceries or get your car fixed, as a general rule with Bitcoin. So those are the problems with gold. You got to store it. You got to move it. You got to maybe insure it while you store it. You pay premiums. The big problem is, how do you get people to trust your gold is the purity that you say it is, or people that want to even deal with the inconveniences of gold? So I look at that as a good store of wealth, but you still got a problem of what you're going to transact business with. And we could conceivably get to a situation where there's a lot of us that don't want to go along with the central bank digital currency. And then I think that's going to be real rough. You're going to need trading partners. You're going to need relationships. People, you can trade a chicken for a pound of butter or whatever. If you're going to be locked out of that currency, it's not easy. You're going to need a whole different, you could call it a black market for a lack of a better term. It's not really quite that, but you're going to need an alternative market that you can functioning with your gold or whatever, sources of wealth you have that you can trade. So store your wealth in gold, but transaction wise, you need a plan.
Mm-hmm. So do you see gold as really the only avenue to store wealth?
Well, or other precious metals. I see, the problem is I've long seen land as the way to do it, but right now real estate is so absurdly priced, it's hard to counsel anybody, go in and buy land. I mean, you're buying it at the top of the market. It would be dumb, and you're paying the highest interest rates you're going to pay in a long time to do it. That would be dumb, You want to wait till interest rates come down and prices lower, which is probably going to happen. So you want to wait that out. I think real estate was a great way to do it. For example, people having a farm where they can raise their own goods. We had a farm, and I advocated that to people. We can raise our own food if we have to, if the dollar does crash or banks crash or whatever. And we sold our farm because it was just getting a bit much to handle. It's 40 acres, many outbuildings, lots of maintenance to do. So we sold it a couple of years ago, but we sold it to a couple that we've maintained good relations with. And I'm confident that if we had to go grow our own crops, that they would give us a little piece of land we could work on to do that. We gave them great bargains on the farm equipment and stuff to help them get started, and I'm sure they would return the favor. So, we've got an avenue there where we could do that if we had to. So that's a good thing, is have, your own sources where you're not as dependent on outside sources. What kinds of things do you recommend to people?
Well, because I think the one thing that I've brought up, and I brought it up recently as well, while I agree with you, another thing that I focus on is skills, building skills, right?
Right.
Knowing how to fix things, knowing how to build things, whether that's, a solar setup for, having a little bit of power that is, can get you through a time, knowing how to fix your own vehicle, change your own tire, little things like that. Obviously up to bigger skills, but
yeah. And those are both benefits, because you're going to save yourself money by being able to do your own work. Mm-hmm. But skills are something you can easily trade on, right? You don't have to take payment in money. You can say, hey, I need my car fixed. If you guys will go fix my car for me because I don't have currency to transact, I'll fix your roof.
Yeah. Yeah, exactly. And I think that's something that a lot of us end up taking for granted.
Right.
Because at this point, because we have, such easy ways to make any of these fixes happen. But when and if we get to a position where there becomes a big roadblock to people transacting and doing business like that, I mean, obviously it's not going to last forever, but I can likely see a time that is a possibility of happening, and I don't want to be able to be reliant, or I don't want to have to rely on other people, to make my furnace work or something like that.
Right. Yeah. So that's a good one. Mm-hmm. So I'm kind of always reaching out to see what those things are, because I'll admit I don't have a lot of ideas of what you do in those kinds of times, just the things that I've talked about. And that's a good thing to add to it. Mm-hmm. Having skills. I always focus on having relationships, and that means having something you can offer to others. It's not about, having a relationship so I can get what I need.
Exactly.
You better focus on having, what you can do to help others. Because if it's not a two-way transaction, it's not going to last. You're just using people. And you want to be able to help people. I mean, if you have a good heart, you want to, but help them in ways that, will also help you. So like you say, with trading off of skills or whatever, the relationships are going to be big.
Mm-hmm. Absolutely. Excellent, David. Well, I think that's, a good place to kind of wrap up for today. Is there anything that you'd like to leave our listeners to think about or to consider before we do?
Well, like as you see with your last question, I'm always looking for answers myself and relaying them out to my readers as I get them. So if you want to track that, almost everything I write is available for free at thedailydoom.com. You may see it says that it's paid material, but the paywall is far down the page, and it doesn't cut off the article. It cuts off some of the accessory stuff to the articles, like all the headlines that I'm quoting from. And so there's 4 days a week where you can track my thoughts completely on the dailydoom.com. And then on Fridays, I do a special deeper report where I get into the nitty gritty on all this inflation stuff and the data and the charts for my paying subscribers to say, look, here's what these things are really based on, and lay it out that way. So.
Mm-hmm. And of course, for those that want to follow you on Twitter as well, that's at Economic Recess, RECESS. David, thanks so much for your time today. Really appreciate it.
All right. Thanks, Tom. Enjoyed it.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.